Is it just me, or does it seem like the banks are currently at war with crypto? Investor Mania reported that the following banks have either blocked or reduced the ability to engage with major exchanges like Coinbase or Binance: TSB, Monzo, Lloyds, HSBC, Santander and Metro, with all the other big players currently in the space having their attitude towards crypto downers under review. Even Mark Tilbury, everyone's favourite YouTube finance uncle, recently released a video where he said that his bank account got closed because of Bitcoin.
My bank decided to dump me completely out of the blue.
There's loads of theories out there on why the banks appear to be trying to kill crypto, but in my opinion, most of them are wrong. So today we'll debunk some of those theories and we'll look at some of the real reasons why the banking space appears to be going all Elmer Fudd on crypto. Today's video is not FUD, fear, uncertainty and doubt. It's my attempt to cut through the noise of what the crypto bulls and banks are saying are the reasons for this clampdown on exchanges, to see if we can make a bit more sense of it all. Because the argument of, well, banks are just haters, isn't a good enough reason for me to stay invested in an asset class. There seems to be two mainstream messages around these blocks. The first is the message from the banks, who seem to be suggesting that cryptocurrency is dodgy, is full of crime, everyone's getting scammed, and all it's used for is money laundering, and that really they're blocking these exchanges to protect us.
Oh, friend!
I get that this message is frustrating. If you're anything like me, you hate paying $1.99 just to get cash out of a cash machine. So to be told by your bank that you can't put your money where you want to because it's too risky is just a bit of a kick in the pills. Furthermore, pot, kettle, black. You got the guys and girls who caused the 2008 financial crisis by taking too many risks, telling us not to take risks with our cash when it was our taxpayers' money that ultimately had to bail them out of the mess. HSBC was one of the first banks to pull the plug on crypto, citing concerns around volatility and a lack of transparency. They are the very same bank that in 2012 allowed the operators of the World Capital Market Ponzi scheme to move millions in stolen funds around the world just months after they'd been landed with fines for previously allowing money laundering.
Thousands lost money in the scam. The fraudsters stole $80 million.
It's a hard pill to swallow when an industry that's been caught red-handed again and again doing shady things is telling you that they're doing something for your protection, especially when evidence seems to suggest that criminal activity within crypto is falling, from around 2.1% of transactions in 2019 to less than 0.5% in 2020. The banks aren't kidding anyone. Cash is still king when it comes to crime. Try walking onto an estate right now and paying Alan in Dogecoin. He's going to tell you to do one. So with this distrust of financial institutions and the hypocritical message of,
"Look at me, Damien, it's all for you,"
we give rise to the commonly held opinion amongst us normal folk and financial influencers like Mark Tilbury that the banks aren't doing this to protect us, they're doing it to protect themselves.
Then it goes a little something like this.
There's a subscriber to the channel called Anthony, and he has a Spotify playlist where he puts all of the obscure weird songs that I reference on a weekly basis. That right there, mate, is this week's entry. So, the opinion that I hear circulating online goes like this. The bank makes money from lending money to people, so if we move our money to crypto, they can't lend it. So they blocked the exchanges to stop us doing that. This is a heavy oversimplification of something that the Bank of England addressed in a recent report. They said, the most significant risk arises from the potential for stablecoins in particular to undermine confidence in money and payments. The banking sector could prove unprepared to withstand large outflows of deposits. Non-banks may not be willing or able to replace bank lending to some borrowers should that be required, and sterling money markets may be disrupted. What does all that mean? Okay, so you may or may not have heard of something called fractional reserve banking. This is a system whereby a bank only has to keep a fraction of the money you deposit with them as cash. The rest can be lent out. To simplify this down further, let's say I walk into a bank now and deposit £10. The bank actually only has to keep £1 of it. They can lend the other £9 out. So at the point they lend that £9 out, they've effectively created money out of thin air. Because in my eyes, I've still got 10 quid in my bank account, but there's someone else out there now that's got another £9. So from that original £10, they've created 19 quid. The fun really starts when the person who's taken the loan deposits that money back into the bank account and the cycle repeats again. This system works fine as long as everyone doesn't ask for money at the same time. And this was the issue Northern Rock had when everyone went to the bank and asked for their cash back.
Thousands of Northern Rock savers have queued for hours at branches to empty their accounts. Many more have withdrawn cash via the internet.
Okay, so when we relate this to the Bank of England and their message there, they're not worried about banking profits. They're worried about outflows from banks into crypto exchanges, which then don't have the ability to do this magical money trick, affecting the monetary supply and ultimately the amount of borrowing that's available in the economy. Non-banks may not be willing or able to replace bank lending to some borrowers should that be required. They're not saying they hate crypto, they're just concerned about the effect on the monetary supply. If you know that every quid in a bank account has £9 to £10 attached to it in loans, if you take billions out of the banking system and put it into crypto, you can see how that could affect the monetary supply by tens of billions. Meaning businesses and people can't get loans, spending reduces, so do incomes, and we get a downward spiral into poverty town. But recently the pattern has been the other way. The money has been flowing out of crypto. We know this because the price has collapsed. Everyone has sold. The whole banks are doing this to protect their profits can be debunked by the fact that the American banks on the other side of the Atlantic are taking a different approach to crypto. The likes of Goldman Sachs and JP Morgan a few months ago were being held up as the poster childs of mainstream adoption. Now it seems that this has been forgotten and everyone is focusing on the UK banks, citing a high-level conspiracy to protect profits and ultimately suppress the technology. If the reason UK banks were blocking crypto exchanges was for profit, then JP Morgan, Goldman Sachs and such wouldn't be sat on the other side of the Atlantic looking to profit from it. Their banks as well, pretty big ones. JP Morgan sold $22 million worth of Bitcoin to its wealth management clients within 2 weeks of launch of its product. So what is going on? Have you ever heard of the Financial Action Task Force? I know, it sounds like the superhero club ever, but it's actually an initiative set up by the G7, a collection of the 7 most powerful countries in the world. If I was the G7, I'd kick out the UK, so every time we entered the room it would be
Like a G6.
I'm not sure that one should make the playlist, Anthony, even if I do love it. The G7 introduced the Financial Action Task Force to combat money laundering on a global scale under Recommendation 1 of the Anti-Money Laundering Framework. The Financial Action Task Force state that checks are to be applied on the basis of perceived risk. If a bank thinks a transaction looks more risky, they need to do more checks. And if they fail to do those checks, then the fines can be massive. For the mess of 2012, HSBC was fined $1.9 billion. Here is actual footage of the G7 spending that cash. Boris was not invited.
The French looked at the dining table and saw an opportunity to have dinner. We looked at the dining table and saw an opportunity to play whiff-waff.
So with that anti-money laundering framework in the back of our minds, we can start to see how it might become an issue for these banks to engage with unregulated exchanges that have unclear business structures. Let's use Binance as an example. I have nothing against them, but for whatever reason, the FCA has come out and said they don't like Binance. So you're a bank and you're about to accept a payment from Binance and you know that the people who regulate you have said that Binance are really risky. So under the anti-money laundering framework, you need to do more checks. That's more man hours, more cost and more time on your back and ultimately more risk to perform those checks. And when reports seem to suggest that Binance don't like cooperating, you kind of have a problem. So it's my opinion, and that's all this is, just an opinion, I'm not a financial advisor, that the reason that these banks don't want to engage with these exchanges at the minute is not for protection of profit, it's not even for protecting us, it's because they can't deal with the compliance nightmare of trying to verify transactions from unregulated entities like Binance. NatWest, which has already said it will not deal with businesses who make money from crypto and has just placed a limit on the amount of money individuals can transfer to crypto exchanges, said this: "We will take a cautious approach to cryptocurrencies and will closely monitor any change of tone from the UK regulator." The key thing is they're looking to the regulators for guidance. This isn't evil banks. This is unclear legislation and a system that puts pressure on banks to do the checks and imposes massive fines if they do not. Add to this the increased workload of performing those checks and one simple truth. Let's say you get scammed by an unregulated crypto exchange, who are you going to moan to? Who are you going to go to and ask for your money back? Your bank. Your bank does not want angry, upset, scammed customers. The whole "it's to protect you" is BS. It's to protect the banks. It's to protect them from fines, increased workload, and a load of angry customers coming to them looking for refunds on scams at the bank's expense. But let's be real here. The exchanges also need to do their part. They need to be coming forwards, working with the regulators, and be transparent. Blockchain technology is decentralised, but these exchanges are not. They are businesses just like the banks. Shouldn't they be coming forwards to prove they're legit? Shouldn't they be adhering to the same anti-money laundering rules as the banks? If they've got nothing to hide, what are they worried about? That ain't FUD, that is fact. So far, 6 crypto companies have been awarded a place on the FCA's Crypto Asset Business Register. One of these includes Gemini, who is owned by the Winklevoss twins, who have always championed compliance and regulation within the crypto space. So there is some form of appetite here from the regulator to provide clearance for crypto companies. And banks aren't against working with companies that are correctly regulated that engage in the purchase of crypto. There is no restriction being placed on the purchase of crypto on platforms like eToro who are FCA regulated. It seems like for now the banks are basically saying we don't want to get involved until there's clearer guidance from the regulators and these exchanges sort their act out. Which sucks if you want to buy crypto. But at the end of the day, these banks were dodgy when they were being heavily regulated. What could these crypto exchanges be up to with no one checking on them? But take a look at the video in my description around Binance's short tokens. They just didn't work or pay out as they promised.
Het headquarters. And so Binance has structured themselves very strategically in order to evade Bitcoin regulators.
If this was a bank, there would be uproar. But because it's a crypto exchange, it's just being ignored, and all those people, they just lose their money. I don't know what the process is to get approval from the FCA, and I don't know if they're being heavy-handed and asking for too much information. What I do know is that 6 crypto businesses have passed the test, but 64 crypto businesses have now withdrawn their applications with the FCA, meaning they won't get the nod to be on the register. You can probably still use these exchanges, but you can rely on the fact that your bank won't like it. Is the FCA being too heavy-handed? I don't know, but it's their rules. If you want to operate compliantly in the UK, it's their game, you got to play it. As a wise man once said, it's like that, and that's the way it is.